Appreciate everybody being on time. We're going to get ready to exit your business being an ESOP. My name is Larry Silver, and we have an expert guest speaker with us, Anthony Levy, with Tenor ESOP Partners. Anthony, great to have you joining us for this hour.
Thanks for inviting me, gentlemen.
Next slide. A little bit about Stony Hill. We are a full-service advisory firm, 14 years now. We specialize in selling privately owned business, more in the small market, 1 to 50 million, but we will go bigger. We've got 8 partners covering 8 states right now. My expertise, my specialty has been construction since the late 80s, and I would say our firm is industry agnostic, meaning we'll do any industry, but my preference and my background is construction. But as an M&A advisory, we do exit value planning, business valuations, we do some intermediary transaction services, and we cover both the sell side and the buy side. And about a year ago, started looking into ESOPs, and we're very enthusiastic about it. Bringing you to the webinar today. We've got 8 different offices covering the Midwest, but we do cover the whole US. Next slide. So some exit options for you owners watching today. We put it in 3 basic buckets or categories. Strategic buyers. This is where a third-party competitor, someone maybe upstream from where you are in a vertically integrated way, or someone who wants to consolidate or do a roll-up. We call that a strategic buyer. A financial buyer typically is a private equity firm, and you can see from the slide that comes in different shapes and sizes. Finally, we call related buyers. If you have a management team that's interested in buying you out, or partners, or if you want to make a transition with your family, we get involved with those kind of consulting transactional services. And the last one in that bucket, as you can see in bright red there, is ESOP, employee stock ownership plan. So that's what this hour is going to focus on, this one part of one of these 3 buckets. So these are some ESOP benefits. You may have heard about ESOPs and maybe don't know the whole story, but I'm going to focus, Anthony, on 7 major benefits. You may not know all of these, but we have found out these are true for ESOPs. Number 1, if you're a selling shareholder, if you sell your business to your employees, you can still retain control of the company directly yourself, or you can also place a certain management group, family, however you want to do it, to still maintain control of the company. Number 2, when you sell to an ESOP, you still get a fair market value for your business. There's no discount. You're not going to get less than what the business is worth. That's a myth. Number 3, you can receive significant cash at closing. You don't have to wait for years to cash in on all the years that you've invested. Number 4, and this is a biggie, as a selling shareholder, you can defer capital gain taxes pretty much indefinitely, or what we say, you can permanently defer them. And Anthony will get into the details of that. Number 5, post-closing, in a fairly short order, an ESOP can become tax exempt, both on the federal and the state level. There are certain conditions. Anthony will clarify that. Number 6, it is a fantastic benefit for your employees. Not just a typical ERISA benefit like a 401k, but significant wealth can be accumulated. And Anthony has a chart to show you what that can look like for your employees. And finally, as a selling shareholder, you can cash in when you close, but you also can get a second bite of the apple somewhere maybe 5 to 7 years down the line. those are the major benefits we're going to focus on in the hour we have together.
Well, Larry, thank you very much for the introduction, and everybody, thank you for taking the time to attend this webinar. Firstly, just as an introduction, and before I get into that, Paul, I think you wanted to do a little bit of a, Paul and Larry, you guys wanted to do a little bit of a Q&A, a question. Is that correct, Larry?
Yes, we want to do a quick poll if Paul can bring that up. But I will clarify that I think you're going to have questions along the way. I've seen this presentation and I had questions as Anthony was going through it. So what I'll ask you to do is either in the Q&A or in the chat, I'll be checking both of them. Put your questions, but realize that we're going to hold the questions to the end to keep the flow and the momentum of the presentation. But I can't guarantee that we'll answer every question, but we can try to email you separately and see if we can answer that question later. But in the meantime, send the questions. I'll try to prioritize them. And we're going to try to leave at least 10 minutes at the end of the presentation to answer significant questions. And then, of course, we can go on from there. So, Paul, do we have the poll? You're muted.
I was starting to say I can't get the poll to start. So it was a very basic trying to get a handle on the motivations for attending, but we'll just continue.
Okay, very good. I'm going to turn it over to Anthony Levy, and I appreciate you joining us, Anthony.
Okay, well, thank you again, Larry and Paul, and everybody, thanks for participating. Just as an introduction, Tenor ESOP Partners is a specialty firm advising shareholders and private business owners on how to use an ESOP as an exit and succession strategy. This is all we do. We are a one-stop shop. What we engage with our clients to design transactions, which we're going to describe in this webinar. Our role is to design and execute these transactions to deliver tremendous outcomes to our clients, their businesses, and their employees. We're a one-stop shop. We just do the design. We conduct a financing raise to create liquidity at close. We quarterback the whole transaction to execution. Shown here are some of our previous clients. We're one of the more active ESOP advisories in the nation, and we really enjoy doing this work. So I'd like to start a little bit about, well, hold on a second, excuse me. I would like to start with what exactly is an ESOP. Most people have heard of an ESOP as a retirement plan, as an employee benefit plan, and that this is an ERISA qualified plan. And what that means is it's qualified in that it provides certain tax benefits to the sponsoring companies and the selling shareholders and the participants themselves. ESOPs are actually very similar to other qualified retirement plans like a 401k. However, there are two major differences between an ESOP and a 401k. The first one is that the ESOP's designed specifically to invest in the actual stock of the company. So your company stock is the investment held in the ESOP trust on behalf of the employees. And then the second main differentiator is that employees themselves do not have to contribute any of their own money to participate in an ESOP. So unlike a 401k, where employees have to make a contribution, employees in this case simply earn the benefit over time. And what that does is it creates this retirement benefit for the employees that ties them to the business, that adds to their compensation package. And it's a long-term benefit, which has a tendency to improve the longevity of those employees. It lowers turnover, and it aligns the interests of the employees with those of the business. ESOPs themselves are not new. The first ESOP dates back to the 50s, but in the early 70s, Congress passed the legislation which really created the benefits, the tax attributes that make ESOPs popular. As of today, there are over 7,000 ESOPs operating in the US, and there's growth every year. In that 10 alone does about 10 to 12 new ESOP formations every year. A leveraged ESOP is simply an ESOP that has obtained financing to purchase the shares of the company. And the financing comes primarily from the selling shareholders and from senior banks. And so we'll discuss that shortly. Larry already touched on the benefits. I'm going to sort of recap and delve a little deeper into the benefits of an ESOP and why business owners look to this as an avenue for exit and succession. Firstly, with an ESOP, there's a tremendous amount of customization in that you can sell a portion of your business or 100% of your business to the ESOP trust. And that can be customized for various different shareholders. So from that perspective, it's got quite a bit of flexibility. As Larry already mentioned, for the shares that you sell to the ESOP, the selling shareholders, the business owners, will receive fair market value. So this is not a discounted sale. It's actually a market sale for the shares sold to the ESOP trust. Another element of this strategy is that selling shareholders may receive significant cash upon the close of the transaction. The amount of cash that's delivered at close is determined by the financeability of the company. And we address that in our transaction design. And we actually, as part of our work, we conduct the financing raise in order to deliver the cash to the selling shareholders at close. Another major benefit, which is very attractive to a number of our clients, is that the sellers can permanently defer the capital gains taxes on the sale of your business. And so for most selling shareholders, when they go to sell their business, they're going to incur a significant tax liability upon close. And that is at the federal level, 23.8%. And then in addition, most states have an income tax which also applies. And so essentially selling shareholders and owners of businesses can sell their business and defer the capital gains taxes, which in the US range from say 20% on up to 37%, in the form of an election of a certain type of IRS treatment called 1042. We won't get too deep into that, but effectively you can defer the gains taxes, and that deferral can become permanent, meaning that you never pay the taxes. Regardless of how much interest owners sell of their business into the ESOP trust, even if they sell 100% of the business, the owners can continue to retain control of their business into the future, and they can transition control to the management team of their choosing. And so this is highly flexible in that you sell your business, you start to take your chips off the table, you continue to operate your business as you did before, and you can elect your own management team and transition control to them on your own timeline. And this can include your family members. Larry already mentioned that the ESOP company, the company that you sold to the ESOP trust, receives significant tax benefits. Those tax benefits initially come in the form of cashless tax deductions, which reduce your taxable profit, and it can essentially eliminate, significantly reduce, and often eliminate the taxes on the business going forward. The end state of our transaction design is a business that is a for-profit, tax-free business. And what this means is that the business itself gets a significant lift in free cash flow because it no longer pays any income tax. And this is a big differentiator from other exit strategies. We mentioned already that the employees themselves get a significant retirement benefit windfall. They do not have to use any of their own money. They don't have to contribute like they do with the 401k. And this benefit is in a long-term ERISA retirement plan, which is deferred to later in life when employees are most likely in a lower tax bracket. And so as they draw the benefit in the future, they will be taxed at a lower amount. This is a significant and material benefit. We're going to show you a chart a little later in the presentation showing what employees realized in an actual transaction that we did last year. Another very compelling benefit of selling your business to an ESOP is that the owners can retain a significant share of the business, a stake in the business in the form of synthetic equity. And this allows for the selling shareholders to realize a second bite of the apple, which happens sort of down the road after the company has paid all the debt off. And the debt is essentially the purchase price that the selling shareholders are realizing through the sale of their business to the ESOP. This second bite of the apple is structured in two chunks. The first one is seller financing warrants, which are essentially equity placed in the hands of the selling shareholders in return for their patience in realizing their return, their purchase price. And that is structured in a way to give the selling shareholders a mezzanine rate of return on what is essentially a loan to the ESOP trust. And then the second piece of synthetic equity is in the form of a non-qualified management incentive plan. This behaves like a stock appreciation right, and like a stock option. And this layer of synthetic equity is used by the selling shareholders to create a very powerful incentive package for the people who are going to take control of the business and ensure it operates into the future. And that management incentive plan has enormous flexibility. We'll talk about it shortly. But firstly, let's just talk about the warrants themselves, which is the benefit that the selling shareholders get, because this is a leveraged buyout, and the sellers themselves are extending the loan to the trust to buy the business from them. So I mentioned earlier that with this transaction, we can create significant liquidity at close through using a standard term loan from a bank. And usually a bank is willing to loan between 2 to 3 times EBITDA, which is an amount of debt that they will extend to the company in order to facilitate this transaction. And very often, in fact, almost always, the value of the business is significantly higher than what the banks are willing to lend. And so the selling shareholders stand behind the banks and they extend the rest of the debt in the form of a subordinated note. And in return for doing that, they receive these financing warrants, which are also behave like a form of synthetic equity. And I'll show you how that behaves over time in the next slide. But essentially, if you think about it, the sellers themselves are entitled to a market return on any debt that they extend to the ESOP in order to buy the business from themselves. And in today's market, that's a mezzanine rated return. Maybe it's not quite 18% yet, but the difference between a small coupon that they get over time and that mezzanine rate of return is structured in the form of these warrants. I did mention that the sellers do receive a little bit of a coupon. Usually it's 4 to 5% of the loan, and that is paid over time, usually in quarterly or annual increments. And all the balance is going to be rolled into these warrants. The upside to that is that the warrants themselves are taxed at a lower rate than if the ESOP was simply to pay you interest, and you would pay income tax on that. The warrants are treated like a capital gain, and they're deferred into the future. And so sellers realize a higher yield on that portion of the value on the transaction. So let's take a look at what that looks like for an actual case that we did. Last year, we sold a company for a little over $30 million. And the sellers, and what you see here on the chart below is the value of the warrants on the vertical axis, and the time over on the horizontal axis. And so if you take a look at year one, right after the transaction, the red line shows that this company is fully leveraged. It's basically 95% leveraged. And with that, the equity of the company itself is depressed significantly because the company's value, the company's essentially being leveraged with debt. And so the warrants are issued at a time when they have no value. And they are literally at par value. There's no value within those warrants, but over time, as the debt is paid down, the value of those warrants increase because the equity in the company increases. And so in this case, the selling shareholders are sitting on warrants after they sold their business for $30 million. And the sellers themselves would have pulled the 30 million off the table by the end of year 5 and possibly the end of year 4. There's a bank loan that's still in place, and as that gets paid down, the warrant value increases. And so you can see that by year 10, that warrant position is worth almost $13 million. So not only did they get their $30 million in purchase price, they also received this warrant, which will be worth, essentially, let's say $9 to $13 million, depending on when they exercise it. They also enjoyed a coupon return. I believe it was 4% on the principal over time. And as a result, the stack up of this can be very valuable. And this is the one piece of synthetic equity. The other is this MIPS plan that I discussed. And we'll discuss that now. So the second piece of the second bite of the apple is the MIPS plan. That stands for Management Incentive Plan. This is a tranche of equity that the selling shareholders themselves can award either to minority selling shareholders who have a longer runway, who are going to be taking over the company, and or the successors who are brought in or within the company or developed within the company or hired. They can take a portion of this synthetic equity and place it in the hands of each individual with a customized long-term incentive plan that ties those people to the business. And this is very meaningful because this can be life-changing value for the people receiving these MIP awards. And it can be structured in a way, and it always is structured in a way that firstly, all the debt has to be paid off. The selling shareholders realize all their value. And after that happens, the MIP recipients can put their equity back to the trust and get paid out. And so what this does is it's essentially a form of golden handcuffs for the people who are going to ensure that your business performs into the future. Like the warrants, these equity grants are made when the company value is significantly depressed because the company's been levered up. The MIP awards themselves are significantly depressed in value. And so when they're awarded, they have virtually no tax implication to the recipient. Over time, those awards grow in value and become a very integral portion of the compensation that those employees are going to realize. And usually this MIP award is in the vicinity of 10% of the value of the company, and that is a fully diluted. That's on a fully diluted basis. So in the future, if you think about a company and you sell a company that is worth $30 million, you place a tax shield over it. It no longer pays taxes. The value of that company is significantly higher, and with it, the MIPS awards become quite material. And so this is a very compelling part of the strategy because it allows selling shareholders to incentivize the people who are going to take control of the business and ensure that they perform into the future. So what does that look like? In this case, this is the same company, a $30 million company we sold. And what you see here is the debt again. The debt gets paid off over 7 years in the red line. You can see we've modeled on the blue line a very modest growth rate. This was a 3% growth rate, and which is very conservative. Now with inflation rising, those growth rates would be significantly higher. But with this conservative approach, you can see that this MIP award grows to over $6 million by year 10. And if it carries out to year 20, it's over $16 million. And so, the people who receive these awards in the early days after the close of the transaction can look forward to this growth in their MIPS pool. And that ties them to the company and it aligns them with the company's interests. It's a very powerful benefit that can be used to incentivize the people who are taking over the business from the selling shareholders. So this is what it looks like if on a comprehensive basis. If you consider that we've talked about receiving fair value for your company, we're not going to pay taxes on that on the gains of that sale. We're going to enjoy the benefit of the warrants themselves and the MIPS plan, and of course the coupon paid over time on the debt itself. You can see there's a big difference in value that a selling shareholder can realize compared to alternatives, which is what we've modeled here. So in this case, we've still got our $30 million company. And we're going to assume that a strategic buyer, maybe a competitor, maybe a buyer who is either a supplier or a distribution partner, may see enormous value in this company and be willing to pay a premium. So if we contemplate a 10% premium over what the ESOP will pay, the strategic buyer would pay over $33 million for that same business. And then, of course, what's going to happen is the sellers are going to pay their taxes on that $33 million. In this case, it was the state that doesn't have income tax. So it was just the federal tax. And so on that $33 million sale, the sellers themselves pay their taxes and realize just over $25 million net tax valuation. And that's modeled on the blue bar down to the lower left. On the very right is a private equity deal. And as we all know, private equity is always looking to buy companies at a discount. And so in this case, we've modeled a private equity sale with a 15% discount. And so with that, private equity is going to pay $26 million. The sellers are still going to pay their capital gains taxes on the purchase price. And they're going to realize approximately $20 million in net proceeds after taxes. And that's shown on the red bar. And now if you want to compare that to the ESOP, the first major thing you'll see is that the ESOP paid fair value, $30.6 million. The selling shareholders paid no tax, and so their net tax valuation is $30 million. They also received the warrants, and they also received the MIPS and a coupon on the interest on the debt itself. Now, as we mentioned, this is a patient long-term kind of a plan. The sellers themselves are taking 7-8 years to pull all their money off the table. In order to do a apples to apples comparison, we took that stream of cash flows and we discounted back to net present value, in this case using a 6% discount rate, so that it actually compares apples to apples with the strategic and the private equity. And when you do that, then this seller realized $34.5 million in net present value on the sale of their business. And so you can see a huge gap between what they realized and what they could have gained if they sold the business to a strategic. And obviously, private equity is always the least attractive alternative. I know this is a bit of an eye chart, but one of the things that you can note is that if you were to sort of ask, well, what does the strategic have to pay in order to match the value? It's over 40% of premium over what the ESOP trust will pay. So it's very, very unlikely that a strategic acquirer can compete with an ESOP in terms of true value. Where the strategic might benefit maybe is where you have a seller who's impatient. They want their money off the table post-close, and they don't want any involvement in the business. And so as a result, the strategic sale looks very attractive. They're willing to take the tax haircut and walk away with less value because they no longer have to be involved in the business, whereas the ESOP is a longer-term plan. And so that's one of the things to note, is that if you're a patient seller, you're willing to have some involvement in the business, sometimes only in governance at the board level. You can actually realize the green bar and basically for yourself and your family, take a lot more value out of this transaction. So let's talk about the employees themselves, because as we mentioned earlier, the substance of an ESOP is it's an employee benefit plan. It's a retirement plan. And the same company, $30 million, and we've modeled out employees earning 4 different salary levels and what their ESOP benefit would be worth over time. And so if you take a look at the blue bar at the bottom, that's an employee who's making $50,000 base salary every year. And at the end of year 6, they've got $63,000 sitting in their ESOP account, which is going to grow to 176 by year 10. And by year 20, if this employee stays with the company for 20 years without putting any of their own money into this plan, they will walk away with over $800,000 in retirement funds. The $100,000 employee is shown in green. And as you can see, that employee is going to realize 1.6, 1.7 million by year 20. And I would also note that this is all based on a very modest 3% growth rate in the company. And most successful companies are going to grow at a much faster pace than this, which means that not only will the warrants be worth more and the MIPS be worth more, but this employee retirement benefit is also worth more to the employees. But this is kind of the piece that gets the employees excited. It's what gets the employees' interests aligned with the business. It helps to build commitment within those employees so they stay longer. And not only do they stay longer, but they feel like employee owners because they have a stake of the business in their retirement accounts, and their interests are to protect the business and to hold each other accountable so that they can all grow the value in their retirement account. So it's a very powerful component of the ESOP exit strategy. Coming back to comparing the ESOP to a third-party alternative, whether it be a strategic purchase or whether it be a private equity transaction. The ESOP has some unique benefits which make it very attractive. The first is this: the due diligence process is much less disruptive. This is a quiet transaction conducted behind closed doors in between the selling shareholders and the trustee, facilitated by the ESOP advisor. So this is kind of this is a big part of why people are attracted to ESOPs, is that they can quietly conduct due diligence in a non-adversarial way without disrupting the business itself. The ESOP transaction itself can be done quite quickly. We can be retained by a client and design and execute their transaction within 3 months. This is a best case scenario. Often it takes longer depending on the client objectives. If there's more discussion around the design, it can drag out. But if everybody's aligned and is motivated, we can get this done in a very, very quick time frame, and as quick as 3 months from start to finish. The actual sale itself, I mentioned, is we're negotiating with a non-adversarial trustee, and so as a result, the clause that usually present in a private transaction with a third party, such as holdouts, earnout, indemnification claims, are much less likely in a ESOP transaction. These transactions can be nailed down and closed without a lot of downside to them, and that's great comfort to our clients. I mentioned the due diligence process is less disruptive. A follow-on to that is the confidentiality of the process can be preserved. So if you think about it, when you're selling to an ESOP, you're creating your own buyer for your business, and you're not putting your business on the market in any public way. And so as a result, nobody's peering into your business. You don't have to share trade secrets, information on your operations. It avoids any competitors who may be strategic acquirers requiring that you share with them confidential information about your business. We're sharing your business diligence information only with a trustee who is a fiduciary bound by confidentiality, And so there's no messaging and no signaling outside of the tight circle of the company selling shareholders, the trustee team, and the ESOP advisor. That confidentiality extends to customers and employees. So if you think that, if you imagine that you can sell your business to the trust quietly, you can control the narrative and avoid anybody learning about this transaction until it's executed. And what that means is precisely at the time you're trying to get your business ready for market, trying to get the performance and the numbers where it needs to be, you're not worried about your employees figuring out that there may be a change and a disruption and starting to look for jobs, starting to create chatter at the water cooler. You can keep this whole thing under wraps until it's all done, and then you announce it to your employees in a very positive way, in that we've done this wonderful thing for the employee base in the form of placing the company in a trust with the employees as the beneficiary. And so you can protect your business from being disrupted by people, either your customers, your suppliers, and your employees, from being aware that you're contemplating selling your business. The purchase price itself is stable. So one of the things that's very common in third-party sales, whether it be to a strategic or a private equity acquirer, is that as the process moves forward and as the due diligence occurs, there's very often deal creep. The sellers, the buyers will come in, and as the sellers become exhausted with the process, they look to pull back their offer. They look to put more conditions on the table, and the deal itself starts to evolve. Very often, the sellers themselves become exhausted with the process, and they just start to concede in order to get it done. That kind of dynamic doesn't happen with an ESOP transaction. It's non-adversarial, it's done quietly, we establish value up front, and you can go through the whole process without the tenuous kind of experience that you may have with a third-party buyer. And then lastly, and I mentioned this before, as did Larry, which is the ESOP transactions can be highly customizable. So you may have different shareholders with different stakes in the business. You may have selling shareholders who have different horizons. This company we sold for $30 million, the owners, there were 3 owners, they want to remain in the business for 9 years. They had different stakes in the business, and we customized the transaction to meet each of their objectives. And we can do that with any client. And so that creates an enormous amount of flexibility in the transaction design. So now we'll talk about who is in the position to consider an ESOP. What are the criteria of a business that lead to a successful ESOP transaction? So the first thing that's critical is this. The ESOP strategy is engineering off of future cash flows. And so the first condition is the business needs to be a cash flow positive business. Because what we're going to do is we're going to engineer this entire transaction off of the future cash flows of the business through a leverage buyout. There needs to be enough scale in the business for this to be efficient. And that's, we typically look for an EBITDA of $1.5 million or higher, so that the tax benefits created in the ESOP are significant enough to create the value that we've described. And then the employee base needs to be at least 20 full-time, non-union W-2 employees. And that's because what we're going to end up with is a subchapter S corporation or subchapter S company owned 100% by a tax-exempt trust. So it's subchapter S, it's a pass-through entity. All the profits flow through to the owners. And if the owner is a tax-exempt trust, it eliminates the tax obligation. In order to qualify for that S election, you have to have enough you have to have enough employees so that you don't have too much concentration in any one person's hands, because what that can do is it can threaten the subject S, and you could lose the tax benefits that are important to this transaction. So a minimum of 20 employees, full-time, non-union W-2. This doesn't mean you cannot sell an ESOP company that's a union shop. That $30 million company that we've talked about today was a union shop. The union employees do not participate in the ESOP. They have their own retirement plan, but that company had something like 25 administrative non-union staff, and those people all participate in the ESOP, and that was sufficient to get them to this fantastic end state of being a for-profit, tax-free business. Succession is important. As I mentioned, this is an exit and succession vehicle. So the leadership themselves has to have a plan for succession, whether it's themselves or whether it's a management team who will remain involved in the business for the duration of the post-closing. So what that means is that in some cases, the selling shareholders remain in the business. In some cases, selling shareholders just move up to governance as the board members, and they place people, they appoint people to run the company, and they give those people a piece of the MIPS plan, the synthetic equity, so that there is a good operations team running the business into the future, ensuring that everybody gets their value. So, and that must be contemplated. It doesn't necessarily have to be in place at the time of close, but before these selling shareholders can fully exit, they're going to have a management team in place running the business. And then the last criteria is this, and this probably doesn't apply to anybody on this call, which is the enterprise value of the business, which the sale price of the business itself has to be supported by the cash flows. And what this means is that, the relationship of the value of the business to the cash flows has to make sense. It can't be like a software company where there's no cash being generated or very little, and the value of the company is 10, 20 times revenue. If you have a relationship like that between the value of the business and the cash flows, it's not practical to do an ESOP. But any traditional company, really in any industry, where the cash flows support the enterprise value, this becomes very achievable. And so an example of that is you're selling a business for 6-7 times EBITDA. That's something that will make a lot of sense and we can pencil. But if it's, well, we basically want to sell the business for 10 times revenue, and that's maybe 30 times EBITDA or 20 times EBITDA, it just isn't practical. And so those are the criteria for an ESOP qualification. And if these are present, it's absolutely worth taking a look at doing an ESOP. There are a number of misconceptions out there in the business community about ESOPs. So we wanted to put a slide in here to discuss those. Firstly, the concept of selling an ESOP is really a way to sell your business to your employees. But you're doing it through a trust, and the employees themselves don't own the business directly. They are beneficial owners of the company through the trust. And so as a result, selling shareholders do not lose control to their employees. They don't need to share sensitive financial information with their employees, although they may choose to. They essentially operate the business after close the same way they did before. The next misconception is that because you're selling to your employees, that management or the employees themselves will have to raise the money to buy the business. And as we mentioned, that's not the case. the selling shareholders themselves are extending a loan to the ESOP to buy the business from themselves, and then we're bringing in a bank to take a piece of that loan off the table to create liquidity for the selling shareholders at close. The minute that bank loan's paid down, the selling shareholders go back, they reload with the bank, and they pull the next chunk of their value off the table. And it works like that until all the purchase price has been realized. But the management and the employees themselves simply earn into the benefit without having to come up with the money themselves to buy the company. We already discussed that sellers are going to receive a fair price for their business. They receive fair market value. And while you may be able to get a premium through a strategic, or you can get a quick sale to private equity at a discount, with an ESOP, you get fair value, and then the additional benefits we described, which stack up to be a very healthy return. Another misconception is that, hey, if we sell our business to an ESOP, and now it's owned by the ESOP trust, and then a strategic comes out of the woodwork with a highly competitive offer at a premium, that we're prevented from selling the business to that strategic. In reality, you absolutely can resell the business, even if it's in an ESOP, as long as the buyer extends an offer at a premium over the value of the business in the ESOP. And so we, from time to time, we will do a transaction, and 3-4 years down the road, a acquirer will seek to buy that company, and the board can absolutely they consult with the trustee. If the offer is demonstratively higher than the value of the business, then it is clearly in the interest of all stakeholders, all the employees, all the synthetic equity holders. It's in their interest to sell, and the business can be sold to that strategic acquirer down the road. And then everybody's value gets pulled forward and paid out at the time of close. So that when as ESOP gets bought through a strategic sale, it can be very positive for all the people involved. There's another misconception that ESOPs are expensive to set up and to administer. We'll start with setting up an ESOP is actually for a small company, it's very comparable to the cost of selling your company. And for large companies, it's significantly less expensive. So relative to alternatives, ESOPs are not expensive to set up. And when you factor in the tax benefits, they can be incredibly inexpensive. And then the administration after the close is not actually that meaningful. It basically, you retain a trustee to oversee the trust, and a third-party administrator to do the bookkeeping for the employee retirement benefit. And those costs, and then the only other component is every year the trustee orders a valuation on the business. But those three components are actually not a lot of money, and they are immaterial compared to the tax-free nature of your business. And so the actual cost to administer post-closing is very little. And you get, and they're more than offset by the tax benefits, and so ESOPs are actually a great value. We already discussed the size of a company that it can work. It does need to be large enough, but it doesn't have to be a big company. And as far as types of businesses, really any type of business will work. The exception are FINRA regulated banks. But we've done ESOPs for services companies, manufacturers. We even have done a SaaS software company. We've done retail. There's no type of business or very few types of businesses and industries that are prevented from doing an ESOP. And I think we already touched on ESOPs are expensive. In reality, they create value. They don't cost in net, they create enormous value. So I've thrown a lot of concepts at you. I want to thank everybody. Here's our customary disclaimer and my contact information. We will roll to the next slide for a Q&A.
Very good job, Anthony. I've had about 15 questions. You've answered maybe a certain amount of them, and I've tried to go through representing Paul because it looked like it was coming from Paul, but I answered about 80% of them. But several of the questions are, what are the implications if you hire an employee post-closing of an ESOP, or if they cash out at retirement? What are the implications financially? How does that new hire jive with the ESOP moving forward?
Great question. So we'll start with the retiree, because that was the first question. So the way it works, when people leave the company, whether they leave the company before retirement, whether they're terminated from the company, because that can happen, essentially they have a vested benefit in the ESOP, which is paid out over time. If the employee is not and this is governed by the plan design, which is a part of the work we do. So under normal circumstances, if an employee who is not of retirement age, either voluntarily leaves the company or is terminated, the ESOP has up to 5 years to start paying the employee their benefit and up to 5 more years to complete paying it. And what that does is it allows for a good runway to pay out that benefit. And that is a little different with the retiree. With the retiree, there's 1 year to start paying the benefit and then 5 years to complete it. And the way this is managed is that ESOPs routinely retain their third-party administrator to conduct a repurchase obligation study to model out the cost of the future retirement benefit. That benefit is then provided, and we model this out as part of our work, and we were able to demonstrate that if the business sets aside 10% of the savings generated by the taxes, the tax savings, and that is sufficient to fund the repurchase obligation into the future. But that is, it is a part of any normal functioning ESOP. It has to do this repurchase obligation from time to time, and it's a capital management issue that's a normal part of operating an ESOP.
Very good. Well, we've got 2 minutes left. I'll see how fast you can answer this. Can you explain what kind of entity is a trustee and how they function in the company? Yeah.
So the trustee is a fiduciary. They're responsible. They do not get involved in operations. All their job is simply to protect the employees, and their principal role is to not pay more than fair value for the ESOP, and to ensure that the employees are taken care of. And so a good example of when the trustee may be involved is if a acquirer comes out of the woodwork and says, hey, we want to pay you 120% of the value of your business if you sell it to us. Because that's a material implication to the employees who are the beneficiaries, the trustee has to sign off on that. Now, that said, the trustee always will, as long as it is a solid premium over the last valuation. So the trustee is really there to protect the employees, but it also protects the selling shareholders by keeping a good arm's length distance between the sale and allows the selling shareholders to be protected from any risk on self-dealing in the sale of the business itself.
Final question, you got about 60 seconds. People are asking about fees and next steps. Can you share about how do you investigate whether you're right for an ESOP if you qualify? What services do you offer, and what would the fees be associated?
Yeah. So the actual cost of doing an ESOP it varies from company to company, but the short answer to this is that Tenor charges a fixed $12,000 fee to do a modeling and analysis and design of a transaction. And for that, it's $12,000. There's no additional commitment. We would take a deep dive of your business. We'll establish a valuation. We will develop a transaction design specific to the objectives of the selling shareholders. We come back and we present that in a 2-hour presentation, which goes into great depth. We will iterate that based on the questions, the challenges, changes in assumptions, sufficient to get so that the client can make a decision on whether to go forward or not. That work also will show show all the components of value. It'll show all the cost of all the participants in the ESOP, whether it's Tenor, the law firm we bring in to document the transaction, third-party administrator, the trustee. We negotiate all their fees up front. We establish value. We model out the transaction. We demonstrate the tax benefits. And so for that $12,000, you get complete definition on the transaction, sufficient to make a decision, and further discussion and review and iterations of that model as needed.
And it appears as though over 50% that go through that feasibility study tend to move forward. That's what I've heard. Is that accurate with your firm?
Yeah, absolutely. The value is evident once you do that modeling scenario. It's very compelling, and it's much higher than 50% of our clients will choose to go forward. Other clients may take it and they'll use the information in the model to negotiate a higher price with the strategic. Those in the case that they're impatient, they don't want to be involved in the business for 5 to 7 years post-close, they can take that work that we did and they can use it to negotiate a higher price with a strategic.
Thank you so much, Anthony, for taking that hour, and we're out of time. We'll try to get to everyone's questions, and feel free to communicate with us. And thank you so much for joining.
Thank you, everybody, and thanks, Stony Hill.
Thank you.
We'll send the recording to everybody as well.
Okay. Have a good day, everybody.